Portions of the following program may be pre-recorded.
The following program is sponsored by Max Out Savings Advisors. The views expressed during the broadcast are solely for entertainment purposes and do not necessarily express the views of KNTH, its management, Max Out Savings Advisors, or its sponsors. Max Out Savings Advisors and members of the Max Out Savings team may or may not hold securities mentioned during the show. Plan for your prosperity, prepare for your retirement, safeguard your savings, and nurture your investments. This is the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Now, here's your host from Max Out Savings Advisors, Ted Gioka.
Good morning and welcome to the Max Out Savings Show. I'm Ted Gioka and we're talking savings investments in your retirement here on the Max Out Savings Show. Our show is all about building up wealth, understanding the world today, and planning for retirement and navigating through. Our motto and our philosophy is to save aggressively and invest conservatively. That's save aggressively, invest conservatively. That's the key to building up wealth over the long term. But as we've been talking about the last couple of weeks, start of the new year, now's the time to really get in there and start investing for the future. Increase your savings plan if you're behind schedule. Once you hit the age of 50, that's when you really want to start ramping up your savings rate, building up your savings so that you're ready for retirement. But retirement typically lasts. If you retire at age 65, you've got a 50%, slightly over 50% chance one of y'all lives to be the age of 90 years old. We're talking 25 years. It's long term. It requires long-term planning. It requires careful consideration. But you have to be there financially. You have to be there health-wise and mentally as well. And so if you're not ready for retirement, now's the time to ramp up those savings and increase your ability to save money. Now, tell you what, you can call us at 713-339-1070. Why don't we take a call here? Welcome to the Savings Show.
Hello, Ed.
Yeah.
Hello.
Yeah, hello. Welcome to the Max Out Savings Show.
My name is Rick. I have a question. Some time ago you talked about the government and corporate money funds and mentioned that a corporate money fund probably would be better to park some money in. Is there any way you could talk about it again to refresh my memory there?
Yes. Yeah, that was typically when it comes to not as much money, but shorter term bonds in particular, in money funds. The money funds I like the best are treasuries, and then I like corporates. I don't like the general government money funds just because those tend to have other types of government securities, which might not be as safe in some type of crisis. The one we use at Charles Schwab for our clients is SNOXX. For that, another good one is the that you can look at is BI. This is an ETF, but it's the Goldman, I think, Bloomberg Treasury ETF, and it's a very solid, safe investment. But again, it's basically it's Treasury bills. It's 3 to 12 month Treasury bills. That's safe. Now, for a little longer term stuff, I like high quality corporates as well as treasuries. And the thinking being, if the government ever gets in trouble, interestingly, I think there's only been five countries that have not defaulted on their debt in the world. And with treasuries, and if that's the case, you're going to be in trouble. Do I think the U.S. is going to default? No, but I also like to be on the safe side when you have $38 trillion worth of debt. So I want to spread the risk around for clients. And so one thing that we do is we also have corporate bonds as well, high grade AA corporates, and we look at the underlying corporate bond to see really what how will it perform in an economic crisis, in a bad economic crisis, and for these, because we're trying to compare it to a treasury. And in that area, we like some of the utilities. We like I like the railroads. The danger with the railroads is there could be a takeover, but you got to be careful there. But you own the big oil companies. You own the oil fields that are in the ground. They're not going anywhere. If there's a crisis, they're still worth something. And that's sort of the thinking. Is in the past, people just wanted to be all in treasuries to be super safe, particularly with for their safe money. But what we've been saying is high grade corporates better. Now what don't we like? We don't like a Bank of America or a Wells Fargo or a Bond or a Goldman Sachs, because these guys could get in trouble. We saw what happened to Lehman Brothers and Bear Stearns, something we predicted in this show a year before it happened. In the same with Enron. Enron was in the energy sector, but they were speculating using derivatives, and they were running. So you don't want financials. You want industrial type of companies that actually have concrete. You can't replace a railroad. An oil fields are there. Sometimes manufacturing, it's a little more difficult. The factory can be losing money and worthless. But that's kind of, and again, this is for, hey, I want to diversify from some of my government bonds into something a little safer, or not safer, but just to spread my risk. Those real high quality corporates are one way to go. But for just the money fund, I would look at at the treasuries. I would look at a corporate. I'm not as wild about just the flat out government. I would try to get in the treasury money market fund. And the other thing, this is actually a good question, is on municipals, with municipal money market funds. What I think there, I worry to some extent about I wish they had like a red state money fund, municipal money fund. In 2020, something interesting happened. Well, not interesting, but the Biden administration, with the crisis, used the COVID crisis to flood the states, and particularly big cities, with huge amounts of money for all types of emergency things, and it allowed them to paper over their problems over the last couple of years. I think a lot of those places had big problems. They increased their benefits. They've increased their employees. Their tax base is eroding. You look at places like New York, Chicago, Seattle, Portland, even L.A., San Francisco. Some of those are better than others. But I think they're in the next big recession. They're going to have real problems in the municipalities because they're not going to have the money they did, and their finances are completely out of control. So that's a long-winded answer to your question, but hopefully that answered it.
Okay, yes, this gives me a good idea, and I appreciate it for the information there.
Okay, sure. And like I said, one thing I really like is that BILS. We have some of that. That's a little longer term than a money fund. And the final thing, and this is a good question. Thanks for the question. The final thing I'll say on this is one thing to remember with money funds. After the financial crisis, they wanted to make sure none of them would ever break a dollar. So what they did is it used to be money markets had their durations typically went out maybe 4, 5, 6 months in there somewhere. So they had longer term things in their portfolio because people never really took the money out. They shortened it quite a bit. And so in some cases, you can also look at some very short-term bond fund ETFs as well. But those are the ones right now.
Okay. Yeah, no, this is very helpful, and I appreciate the information there.
Okay.
Talk to you later then. Okay. Bye-bye.
That's a question on money funds, and that's sort of our thinking along those lines overall. And money funds have been yielding pretty well. They're yielding, over 3%. They were yielding over 4% until just recently. The good opportunities. This is why we sort of a year ago, rates are coming down. We said we like the two-year treasuries, 2-year bonds. And want to kind of continue to demand. That's for your short-term, ultra-safe money. in the markets. And again, some of this stuff, as I said, do I think treasuries are going to default? No, but it's if you can kind of, particularly if you're real concerned about risk, you can spread your risk into some other assets that are going to hold up pretty well. The numbers are really fascinating. I forgot the actual countries. Somewhere I had a list of them, but there's only about 5 of the countries that didn't default. England defaulted on some war bonds, I think from World War I or II. They were kind of a quasi, but it's remarkable, the list of countries, and you tend not to get your money back. Whereas with a AAA, the AAA paper in corporate world has a much better default rating than governments. So there's not much AAA out there. I think maybe Johnson & Johnson, Exxon. I'll have to figure that one out, but anyway, that's the story. So you want to look at the underlying assets. And one of the things that's always kept us out of trouble is like I said, we avoid some of the financial, because the financial balance sheets can destabilize much quicker is the problem, and they tend to run off of that. Anyway, those are some thoughts there. Looking out, actually interesting now that we're kind of on this. One area I wanted to touch base on. Interesting thing is the 10-year. One of the things that we've been talking about on the show in our Max Out Savings Report, which we send out once a month, I'm going to try to get out at 2 this month. But for 2026, we're looking for an economy that is going to do much better than it has in the past. And we're looking. I think you could see some 5% growth rates in here, which is going to be very good. And it's pretty simple. What we're looking at is, if you look at the AI spending, and the AI spending, numbers are all over the place. The mid levels maybe $350 to $400 billion for AI spending. You've got electricity build out. You've got the Defense Department is engaged in a massive build out because we're so far behind on so many of our munitions and our defense projects. And then you have all the factories that President Trump has negotiated to come back here, everything from automobile factories to drug production facilities, all types of different things. When he talked to a country, usually some of the companies in the country will go, well, tell you what, we'll put a factory in. And he goes, okay, well, this is good. And so you've got it. The number we're using is at least $500 billion, and I think it's a very, very conservative number. It coming in this year. In addition, you had the government slowdown in the third quarter of last year. There's going to be more catch up this year, and a lot of people were under withholding last year because changes in the big beautiful bill that President Trump put through. They're going to get big tax returns coming up in March, April, May timeframe. So a lot of positive stuff is happening, but in the economy is going to be better than expected. The consensus is interest rates are going to be plunging all over the place. We're not convinced of that on the longer end. And I'm just looking at the 10-year. The 10-year has broken out on the upside here recently. From it really had a top around 4.2. It's at 4.3, which is kind of the first really breakout since about September of last year. And so, and again, we just talked about the demand for factories for AI. I just saw Meta, actually, I think it was the Journal today, one of them actually said that Meta hired an a banker, actually because they need so much money for AI. I mean, there's big demand for AI. There's demand for money, because how are you going to fund all this stuff? And that's going to, I believe, push up the cost of credit to some extent. And we're seeing that on the 10-year. They still would like to see the short-term rate go down, but the very short term, but the longer rate has gone up. And as we've talked about on this show, the since September of 23, when the Fed started raising rates. I think I want to say they were around 4.3, somewhere in there. The longer end has gone up 80 or 90 basis points in rates. So as rates fell on the short end, the long rate went up. So this is something we want to watch. We're expecting a good year for 2026, but it's a much more volatile year in the markets. That's what we'll be right back after this quick break right here on the Max Out Savings Show.
The Max Out Savings Show with Ted Gioka is taking your calls now at 713-339-1070. Ted Gioka will return after these messages.
I'm Ted Gioka, and I approve this message.
Inflation, instability in the market, bonds, precious metals, oil and gas, and lack of old-fashioned cash puts your retirement at risk. It takes a different type of portfolio to deal with these issues. And that's where Ted Gioka can come in, and he can help. Go to MaxOutSavings.com and schedule some time with Ted. That's MaxOutSavings.com. And listen to the Max Out Savings Show every Saturday at 10 a.m. on AM 1070 and FM 1033. The Answer.
Hi, this is Ted Gioka of the Max Out Savings Show. Our motto and philosophy is to save aggressively and invest conservatively. The world is changing at a faster rate than any time in the last 50 years. The investment world has changed. Have you changed? Inflation will destroy your retirement. It is a different world that requires different strategies and ideas. The era of indexing and investing is over. If you need help, listen to the Max Out Savings Show. Our show airs every Saturday at 10 a.m. and Sunday. We talk about investments, the world, and where the world is going today, and help you understand it and help you save money and build up wealth. It's the Max Out Savings Show. And if you need some help, go to our website, maxoutsavings.com. That's maxoutsavings.com. On the website, you can sign up for the free Max Out Savings Report. Our report covers all types of these big issues, the changes in the world, and helps you understand and protect your retirement. So go to the website, maxoutsavings.com.
This is Ted Gioka, host of the Max Out Savings Show, one of Houston's most popular financial radio shows, celebrating over a decade on the air in Houston, Texas. With stocks at record high valuations and interest rates near record lows, you need to have your guard up. You need to have a plan to manage risk to your retirement. Do you? At Max Out Savings Advisors, we have a risk-based value investing approach to your retirement. If you would like some help managing your retirement, go to maxoutsavings.com to set up an appointment. That's maxoutsavings.com.
Once again, here's your host for the Max Out Savings Show, Ted Gioka.
Welcome back to the Max Out Savings Show. We're just talking savings investments in your retirement. Looking out over the markets in here, and one of the more interesting things that we've been seeing in here has been the silver market, and it has just exploded higher. Long-term listeners of the show know that we have just loved silver, gold. We pointed out the advantages of it, and we've just had huge outperformance in silver. I think it was up over 140%, in the stocks, just massive move. Silver itself is about $90, and one of the 89, about $90 is where it closed, and it's up again this year as well for the new year. But we talked about the Samsung. It has they're working on a battery, a silver-based battery, a solid-state battery, which is depending on who you talk to, it could go somewhere between 6, 7, 800 miles on a charge, and then recharge in basically 10 minutes. And so that's very bullish for silver. Silver over the last 5 or 6 years has had a deficit from mine production to industrial usage, and there's huge demand for going into silver for electric cars, for AI, for electronics. It's just one thing after another out there. But one of the interesting thing is that Samsung has made a deal to purchase silver from a a 2 years of production from a mine in Mexico from a silver mining company. And this isn't the only one. Amazon came out and they're producing production from Rio for copper on a new project that Rio has in the United States. Rio Tinto has in the United States. For copper, again, it's another situation of copper is basically the electric grid. Our electric future is basically built on a copper on a base of copper. Copper is the most efficient metal that's reasonably priced for transmitting electricity, and so it's gone up over $6 a pound, and so Amazon is purchasing the production for this mine. Now, this is interesting in a couple ways. It shows the demand for metals in general. I mean, it's not just silver; it's gold, it's copper, it's aluminum, it's other metals as well are all going up. I mean, countries are stockpiling them instead of as part of their move to change up the foreign exchange reserves, but in this case, these two cases point out something very interesting. In the silver market, I've seen numbers all over the place, but the number seems to be there's about 350 million. That number's probably declined now to this run in silver. Ounces of derivatives for every ounce of physical metal, 300 times every ounce of derivatives for every ounce of physical metal, and which means there's a whole bunch of people promising things based on the price of silver or promising to deliver that there's no way they can deliver. And so companies are moving away from the COMEX, where they used to hedge in the futures market, and they'll take contracts for, maybe 100,000 ounces of silver or 1 million ounces of silver on which is their production needs for 2027. They'll buy contracts just to hedge out their position and know they can exercise their contracts and request delivery. And what's happening is people aren't sure they'll be able to get the delivery because of shortages. And so what they're doing is they're going directly to the miners and contracting with them to have the silver or the copper delivered directly to them, so they know they have an assured contract. And this is a big deal, and it shows you the weakness of all these derivatives out there, that people aren't sure what's really behind them. Who are the counterparties, and then do they have the collateral to deliver? And this is, I think, collateral could be one of the big stories for 2026 is, do people have the collateral they say they have, or are they just making things up and hoping to buy it into the market or do something? And we're in a situation now where we have where some of these people might not have it, and silver is the one it's really showing up on. And the COMEX has raised the contracts, the margin requirements for the contracts 3 times. It hasn't even really affected the price at all. And people forget the only time they were able to stop the Hunt brothers, who actually cornered the market at the time, was when they said all you can do on the futures, you can't buy silver anymore, you can only sell silver, which is, kind of blew the whole thing up. But the Hunt brothers had cornered the commodity market at the time. They bought up all the contracts, and so people had to deliver, and they couldn't get the silver. Well, in this case, it's the kind of the other side of the trade, where people have sold a bunch of stuff, and they can't get the silver back this time. So the shoe is kind of on the other foot, and it's actually the people on the other side of the contracts. And this time, the COMEX can't raise the margin rates because the big marginal buyers are Asians. They're like, hey, we'll take all the silver you can get. And they can raise contracts, and they're like, we'll pay cash, we don't care. And so this is why you're seeing these huge moves up in silver. I mean, silver's had a massive move. Somewhere it could correct. And we've sold some stuff up here just because we've had it for a while. We've had such large positions, we had to manage it. But but it could go down. But it's silver at $90. If it just goes down to 50 or 60, these companies make a lot of money, and it could go higher. And the question for one of the big questions for 2026 is there going to be collateral issues? Are there other collateral issues out there that people don't know about? And the silver is highlighted. What about the Treasury market? Is there collateral on some of these treasuries, maybe they're not really there? You're not heard about that, but the same thing for gold, the same thing for other things out there. There's so many derivatives and repos and all types of things. The question is there problems with that? And that's something we want to watch closely out there. I think one of the things we really talked about in the Max Out Savings report is the fat tail risk in this market. There's a lot of stuff out there. Things look very good in this economy. I mean, Donald Trump has put together the most exciting, we've said this in the show, the most exciting, the best group of cabinet of anybody since Roosevelt in the 1930s. I mean, he's put together a world-class group of people, and you're seeing what they're capable of doing. He's put together the big, beautiful bill. I didn't even mention about the 100% depreciation companies are getting, for putting in buying things, manufacturing things, even buying a tractor or buying a certain type of automobiles and stuff. You get 100%, and that's driving a really great economy. But there's these things out there that are a fat tail risk is something on a distribution curve that it's like. It's a bell curve. A distribution curve is, what are the chances this happening? What are the chances that happening? And then out at the tails, it's only a 3 or 4% chance of happening, but if it does, it's going to cause a big problem. Well, there's not a lot of these things. People, we talk to them and they go, well, that's just a small chance of that happening. Well, there's just a small chance that interest rates start really surging up. There's really a small chance that the interest rates in Japan, which have risen dramatically, cause a real problem and cause the carry trade to collapse. There's just a small chance that the Russia-Ukraine war spreads. There's just a small chance we get involved in Iran. There's just a small chance China comes into Taiwan. There's just a small chance that the collateral becomes a big issue with silver and cause. But the problem is you add all of that stuff up, and it's not just a 1 or 2% chance, but the possibility is 10% or 20% that one of those things happens, and that's where the real risk is in 2026. And this is something we want to kind of continue to watch. I mean, the year has started out really phenomenally well. It's been very exciting. Numbers are going up across the board. The S&P 500 is up nicely, and the economy looks really good. And so this is so. And a couple things we're seeing for the new year. Money appears to be coming out of the big mega cap techs, and it's going into different areas of the market. One of the best areas is really the Russell 2000, the smaller stocks. They're going up quite a bit, and that's probably the best because they're figuring manufacturing is going to take off. There's a lot of those stocks in the Russell 2000. There's a lot of smaller stocks that are going to do well. The housing is looking like it's turning around. President Trump has talked about housing, and he's going to try to limit big companies from buying housing. I think housing is going to be one of the big stories this year. Look, we have a congressional election coming up. Most of the time, Republican or Democrats don't pay a whole lot of attention to Republican who gets they pay a lot of attention to it, but it's not a disaster, and they don't run the country for it. But the problem is the Democrats have made it clear they're going to take everybody out. Anyone that's a conservative, they're going to be indicted. They're going to be impeached. We're going to have committees. We're going to start rearresting, anyone that supported Donald Trump and whatever. And all of a sudden, the midterms become a life or death type of situation, and so they're putting enormous amounts of firepower into the economy to make sure the economy does well. And so Trump, as we talked about in the show a month or two back, he's going to have to shift to be more populist. Affordability is a big issue, and he wants to be at the center of that. And we're seeing that big companies shouldn't own houses, which is ridiculous. I mean, there's two schools of thought for housing out there. You have the Larry Fink, the Davos model of you'll own nothing and you'll love it. And then you have the capitalist and, quite frankly, the communist model of, well, we want to have home ownership. Even the communists in China, everyone owns their home. You know, in Europe is more used to serfdom. They've dealt with that for thousands of years, so that's their philosophy. But and so then he came up and he said, look, I want to put a limit on credit card debt of 10%. Well, a couple interesting things happened. So Trump is trying to make it look, he wants to help out working people. And candidly, if you look at the credit card debt, if you look at how the Fed, remember we had interest rates close to zero and they were still charging people 15% on their credit cards when rates were zero, and they were getting the money for virtually nothing. And then when they went up to 3.5 or they were at 4, the rates went to 20 in many cases or more and up into the mid-30s. And so clearly, I mean, I'm sure the mafia is looking at this and goes, why aren't we doing this? You know, let's skip the beating people up. Let's just do credit cards. But it's been fascinating to watch the other side come back and listening to, I mean, watch a lot of business TV, you know, CNBC, Fox Business, Bloomberg. I've got a Bloomberg system on my office, and so I get enormous. I mean, over the last week or so, since President Trump has wanted to cut credit card, keep them at 10%, I've realized if we really want to get the economy going, because they've said, look, if you force credit card rates down, people won't be able to get as much credit, so the spending will cut and the economy will go down. Well, the corollary to that, I'm assuming, is maybe we should pass a law that everyone's credit card rates go up and they'll spend that much more money because there'll be more credit available. I mean, it's just been completely stupid to listen to these people. But there's an enormous, I mean, very few congressmen to what's her name, Pocahontas's credit, Elizabeth Warren, she came out and said, yeah, this is a good idea. And actually Trump called her up and talked to her on it because there's so much money going to these congressmen from the credit card companies and the banking companies that none of them will say, well, maybe we should cut rates. Do we think they're going to cut rates at 10 to 10? Absolutely not. But can they put a credit card rate cap on credit cards at a reasonable amount? Yeah. Probably so. And will it cut some people out? Yes. But see, this is what you have to understand is when they're giving these super high rates, they're expecting a whole bunch of people to default. Well, with all these defaults, we're all paying for the defaults and our credit card rates go up. So if you set a reasonable price for credit card people rates, then you're going to limit people to keep people from getting too much credit and hurting themselves and people taking advantage of them. And at the same time, the rate should come down overall. Maybe that's a reach there, but clearly credit card rates don't need to be at 32, 33%. That's just ridiculous. And they're taking advantage of people. The same thing with housing. To listen to the people on CNBC and Bloomberg talk, you would think that Blackstone and BlackRock, and I know it's maybe not them, but some of their companies are when they spin off, but they were both in it. To listen to them talk, they actually weren't trying to make money. They were some type of charitable organization that was just providing housing. I mean, to listen to this stuff talk is just incredible. It comes down when you're a family and you're starting out and you're putting down a little down payment and you got to go through the credit card company, and here comes BlackRock or Blackstone or their subsidiaries or their derivatives of that come out and saying, look, we'll close in 2 weeks. You're being priced out of the market. And what they're not telling you in hot markets like Nashville or Austin, that's where all those guys are at. So people are moving in to start a new life, and they're competing with big corporations. And so these corporations aren't doing anyone any favors. One of the key tenets of the United States of America is ownership, and we need to get big corporate America out of the purchasing of single family homes. And I think even individuals should be limited. They can buy as many houses as they want, but they shouldn't get any tax breaks for them beyond a certain point. If someone buys a house and they move in a bigger house and they want to rent it, fine, or they get a vacation home or have 2 or 3 houses or even a little, I don't care. But this idea of people starting out a family having to compete with corporate America is unfair, and it's hurting the central tenet of capitalism in the United States, which is home. One of the central is really home ownership. It all starts there. Anyway, let's take a quick break. We'll be right back right here on the Max Out Savings Show.
If you've got savings and investment questions, Ted Gioka has answers. Call the Max Out Savings Show now at 713-339-1070. We'll be right back.
Hi, I'm Sam Malone, the owner of Houston's cutting-edge media company called 512 New Media. At 512 New Media, we create amazing videos that companies use on their websites, telling their story in bold colors with exciting animation and graphics. At 512 New Media, we also shoot television commercials and instructional videos. And if you want to show off your business from the air, we're ready to go with our drone video aircraft. Let us help you create your media message. We're online at 512newmedia.com or call 281-822-8803. 512 New Media is Houston's only media creation and distribution company that's actually owned by someone who's currently on the air. And that gives us an incredible edge when creating content for consumers to use on their laptops, tablets, and smartphones. Standing by to create your message, we're 512 New Media, 512newmedia.com.
In the 1970s, the big song was the Bee Gees' Staying Alive. Well, it was difficult back then to stay alive if you were a retiree. Inflation was running rampant, and since then, over the last 25 years, it's gone away. Well, inflation's coming back, and it's going to endanger your retirement. If you're a retiree, inflation is your biggest enemy. Hi, this is Ted Gioka of the Max Out Savings Show. If you need help with your retirement, I'd like to help you out. Go to maxoutsavings.com. That's maxoutsavings.com, and we'll show you how you manage through inflation. Don't let inflation destroy your retirement. This is Ted Gioka, host of the Max Out Savings Show, one of Houston's most popular financial radio shows, celebrating over a decade on the air in Houston, Texas. With stocks at record high valuations and interest rates near record lows, you need to have your guard up. You need to have a plan to manage risk to your retirement. Do you? At Max Out Savings Advisors, we have a risk-based value investing approach to your retirement. If you would like some help managing your retirement, go to maxoutsavings.com to set up an appointment. That's maxoutsavings.com.
We return now to the Max Out Savings Show. Here's Ted Gioka.
Welcome back to the Max Out Savings Show. Looking at the big beautiful bill, a couple of the things coming out. Again, this is a big story for this year. Is there's a lot of deductions on this, and I want to run some of these by you so you can kind of understand it a little bit. For 2025 is if you're over the age of 65, you get an additional $6,000 deduction. A married couple gets $12,000. Now that goes up for a married couple. It starts at It starts at 150. If you make over 150, it phases out a little bit, and at 250, it phases out completely. Same for single 75 and 175. But it works out to be, if you're a married couple, your standard deduction is about $32,000. There's a little deduction in the past if you're over 65, but now it works out to be you're getting over $44,000 is your standard deduction before you just start doing your taxes, which is a pretty good deal for most people. And for all practical purposes, it makes most people's Social Security tax free. And so this is something we want to kind of watch. a little more closely. Also, the SALT cap increased to $40,000, and that's a good deal as well. But that's not as big a deal down here as elsewhere in the country. And again, these things phase out. You got to look at that. I mean, that's one of the things you kind of have to watch here. The COLA is probably going to go. Your Social Security is probably going to go up about 2.5% there, and the estate tax deduction is for 2026 is going to be $15 million. So those are some of the big ones to look at. They have the 11,250 catch up between on you can put into your IRAs or your 401ks between the age of 60 and 63. This is a really good way to cut back, to build up some money, to try to ramp up again, hit that last before you retire, really put away the money as much as possible. It kind of helps out two reasons. It helps you kind of manage your expenses a little bit better because you're putting away more money, so you have less to spend, which you'll have a little less at retirement. And then you also really build up your savings. Okay. Welcome to the Max Out Savings.
Hi, Ted. How are you today?
Pretty good.
Hey, I have a question about Venezuela, since it's been in the news here lately, since they arrested the leader there. Do you see this as having a big impact on gas prices for us here?
I don't think Venezuela's that's actually a good question. The quick answer is Venezuela's energy infrastructure is a complete basket case. I mean, it sounds like it's held together with baling wire for all practical purposes, and they've done very little maintenance. It's just and so it's going to take time. They're going to have to come up with an energy law down there, pass an energy law. They're going to have to convince people to come down there. It's going to take time. As far as gas prices, that's an interesting question because most of this oil's been going to Cuba and it's been going to China, so it has to find another way to go. Now, oil is real fungible, but our refineries on the Gulf Coast a lot of them were really built for Venezuelan crude because it's a heavy crude, and it in some cases, there's other it's sour, but so you need a cat cracker for that, a catalytic cracker. And so they're going to move a lot of that back to the Gulf Coast and pay the Venezuelans. So it could drop the price some of gasoline on the Gulf Coast. Now, but because we've been importing a lot of oil from Canada, just because these refineries, many of them need a certain type of crude, to run through. So the long answer is probably not, but a quick answer is really you got the possibility, or vice versa. You got the real possibility that it could keep down gasoline prices on the Gulf Coast simply because it's going to give them more crude to refine, probably at a little cheaper prices. Overall, oil is fungible, and that's kind of what I'm thinking. It was a master stroke of genius to do this because it puts China on their back feet. That was the centerpiece of their South American expansion. The Cubans are basically being subsidized by Venezuela, so it puts them in a tough spot. If he can pull it off, and one of the things they appear to be doing with some of these countries or regimes is they go, look, if you can come up and you can hold elections and you can have freedom in your country and you respect the rule of law and won't kick us out, we'll kind of tolerate what you're doing. I mean, we're not here to set your government up, but you have to be fair. And that because he left in the vice president, and I think from what I've heard, she seems to be a very accomplished technocrat, and likely all the money she's raising up through all these deals is being siphoned off all over the place so they can kind of actually get it to where the people are. It might help out. And so it's an interesting thing. But yeah, that's kind of my read on that.
So, as you mentioned, there'd have to be some kind of guarantee for any any companies that go down there to help them put their infrastructure back in order. Do you see that happening?
Yeah, I do. Look, their oil infrastructure is a complete basket case. And if you look around the world, I mean, candidly, American oil companies come in, and actually it's European oil companies and the Chinese come in. They fix the place up. They give you your share, they pay you, and then they just want the concessions, and they make money off it, and you make money. I mean, the problem seems to come in. It's always a really good idea for them to take over their own thing, but the problem is it's not even. Venezuela had a remarkably good oil industry, but what happens is then a bunch of corrupt people get in there and start siphoning things off. And well, we really don't need to update the refinery. Why should we put another pipeline in? Let's not drill another oil and gas well. And all of a sudden, the place is in shambles. And so, yeah, I mean, I think it's really possible because candidly, Venezuela has been a disaster. It's the only country I've ever read outside of North Korea. And, in a few things in the past where the people in the country actually lost weight. I mean, there was actually a statistic out there because they were there was no food in the country. And it's been a complete disaster. And in Venezuela, before Chavez got in there, was the crown jewel of South America. And so, I think it's going to work. I think it's going to take time. I think Trump's trying to be as prudent as possible.
Okay, I was recently listening to a podcast with Michael Schellenberger. He used to be a leftist. Mm-hmm. He actually worked for Chavez, and he basically said Chavez broke him of his leftisms. But he said Venezuela is a oil company disguised as a country. So he says they've got nothing else but oil, and if they can't get that out, they really have nothing. So
yeah, that's the problem they ran into, and so they've got to bring help back in there.
Well, he also said the corruption was more than just at the top. He said it's endemic; it goes top to bottom. But he doubts that we can clean it up. But if the Venezuelans can do something about it, he said, then they've got hope for the future.
Well, the one thing you can do with oil is if you can sit there and get it working or get the fields working and monitor them, how much oil is coming out of the ground, where the money's. It's like, here's the money. You can deal with a little bit of corruption, but you can at least kind of control it if you try to get in there and do it. I mean, and I tell you, the other thing that's most likely to see happen is keep in mind the biggest discovery in the last 20 or 30 years has been Guyana, sitting right next door. That's the crown jewel of Exxon's operation. That's why Exxon really doesn't. I mean, I'm not sure they even really want this oil working, but they're going to give some offshore things, which when you're offshore, that's what they do in Africa. I mean, they love the offshore stuff because no one can get near it. I mean, onshore, you wouldn't believe the stories I heard about Tanzania and stuff like that. I mean, I think one of the oil companies, not an American, actually brought in the Wagner Group, and even they couldn't control the operation in there.
Wow.
So, yeah. So.
Okay.
It's interesting, but yeah, that's kind of my read on that.
Okay, thank you very much.
Okay, thanks. Yeah, we got the situation with Greenland. I tell you what, I think the thing to watch is I think they're going to come up with something with Greenland. I'd be surprised if we invade the country. I mean, but the concern I really have is Canada. I mean, keep in mind, right now, Alberta is looking. They're going to put a ballot to succeed from Canada. It's going on here's huge lines for people signing up to sign the petition. Carney is a hardcore Davos globalist, and they just cut a deal with China to import electric cars. And we're not going to we're only going to tolerate so much from Canada. We cannot have a Chinese-controlled country on our northern border. That just is not going to happen. There's just no way it can happen. I mean, for all the talk of everything else, we cannot tolerate that. Anytime you let your enemies on your border, you're asking for trouble. And so I think Canada's the one we really want to watch. I think there's more problems there than we realize. The other interesting thing is, Davos is next week, which we've been a huge. I think the biggest threat to the United States has been Davos. I've felt that more than China or anything else. They're the ones that came up with "you'll own nothing, you'll love it." They wanted to decarbonize the world. They wanted to get rid of the oil and gas sector. They didn't believe in borders. But Donald Trump is sending a massive contingent. He's going to be speaking. Secretary Bissett is going to be speaking. Marco Rubio is going to be there. And they appear to be, I'm not sure if they're trying to influence or change the direction or get control of Davos. I'm not sure, but that's something we want to watch closely. I think it's going to be very interesting to kind of see what happens there with that. That's this week. What else do I have I want to cover here? Okay. I think that one of the keys is we need to watch those longer-term rates here for this year. I think it's going to be interesting to see what the precious metals market is. I think they're all going to report huge numbers coming up across the board in the gold and the silver markets. I think that's something we want to watch. And it's still like the natural gas sector. But a couple things. We're going to be putting together another Max Out Savings report. I'm going to try to cover some of these tax issues in the report coming up here shortly. If you're not on the list, we come up with all types of things in the report to help you understand the world, deal with retirement. It's just go to maxoutsavings.com. That's maxoutsavings.com, and you can request a be put on the list, and it's just you're on the list. That's all it is. We're not going to call you up. I think years ago I did seminars, but even we haven't even done those. We don't really send out anything but the report. So if you need some help, go to the website. And if you need some help managing your retirement, you're retiring, you have an old 401k or trust or something, that's what we do at Max Out Savings Advisors using a value investing approach to the market. Just go to our website, get the email or phone number, give us a call or send us an email, and we'll set up an appointment here in Houston. This is our headquarters, and I'll be happy to sit down with you and show you how we manage money using our value investing approach. Anyway, until then, remember our motto and philosophy, which is to save aggressively and invest conservatively. That's the key to building up wealth. If you're behind on your savings, go to your HR person, build up your savings, take charge of your future. It's going to be a much better future when you do that. Anyway, I hope everybody has a great weekend, and we'll see you next week right here on the Max Out Savings Show.
This has been the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Join us next Saturday at 10 a.m. for the Max Out Savings Show with Ted Gioka on AM 1070. The Answer.